Good morning, everyone. The appointed hour of 10 o'clock has arrived for today's hearing on public hearing of the Transportation Committee of the Senate in our ongoing effort to look at all the options for funding transportation, highways, bridges, and mass transit, and all of the other ramifications. Today we're going to look at the proposed oil company gross profits tax from both the, we're honored to have our Secretary of Revenue, acting Secretary, I guess to be correct, and we'll also have a presentation from the Fuel Distribution and Petroleum Industry Panel. Should we swear him in? You please rise and raise your right hand. Do you swear or affirm that the testimony you're about to provide is the truth, the whole truth, and nothing but the truth? Thank you very much. I'll now turn it over to our Acting Secretary of Revenue, Mr. Thomas W. Wolf.
Thank you, Senator.
Secretary Wolf, thank you for being here and willingness to make your presentation.
Thank you for having me. I have a prepared statement, if I might. Right. Chairman Madigan, Chairman Stout, and members of the committee, thank you for giving me the opportunity to testify about the governor's proposal for solving Pennsylvania's transportation funding crisis. In the next few minutes, I will outline that proposal, which would exempt oil companies from paying the Commonwealth's corporate net income tax and would impose on them instead a gross profits tax. The proceeds of this tax would be dedicated exclusively to funding public transportation in Pennsylvania. As the Transportation Funding and Reform Commission concluded, we need to increase funding for the Commonwealth's transportation systems. Traveling along the East Coast and between the East Coast and the Midwest almost always involves traveling through Pennsylvania. We have relatively more bridges, more highway miles, and more traffic than most other states. Our communities cope with these high traffic volumes by diverting a portion of their surface transportation usage to public transit. These two systems, highways and bridges and public transportation, work together in an integrated manner to provide an essential foundation for our state economy. Our economy depends on our transportation systems, and our transportation system depends on adequate funding, not only for our roads and bridges, but for our mass transit system as well. Unfortunately, Pennsylvania has failed to make adequate investments in its surface transportation infrastructure for too many years. As a result, our mass transit system now finds itself in a financial crisis. This financial crisis will pose a clear threat to the Commonwealth's economic growth, quality of life, and public safety if it is not adequately addressed in a prompt manner. The Transportation Funding and Reform Commission concluded that over 5,900 of our bridges, or 23%, are structurally deficient. Their average age is 50 years, and far too many are nearing the end of their useful lives. Over 8,500 miles of state-owned roads and 32% of our secondary roads are in poor condition. By delaying necessary repairs to this vital infrastructure, the current cost of repairs has grown by $350 million just due to inflation over the past 10 years. According to the Commission report, Pennsylvania's highway and bridge system is in need of an additional annual investment of $965 million in today's dollars. And again, that's additional annual investment. Mass transit faces a similar crisis. Unless there is significant investment in Pennsylvania's mass transit system, there may be a 25% service cut over the next 5 years, resulting in 100 million fewer rides per year. This will translate into a loss of access to jobs, medical services, and schools. It will also translate into increased congestion on our highways. Addressing the funding crisis in mass transit will require an additional annual investment of $760 million. As you know, Governor Rendell considered various options to fill this transportation funding gap, including increasing various taxes and fees and tolling the interstates. These options, however, would have imposed significant tax burdens on Pennsylvania's citizens and businesses and would have raised state liquid fuels taxes to unacceptably high levels. The Governor agrees that our transportation funding crisis must be solved this year, but he is committed to finding a solution that will minimize the impact on Pennsylvania's citizens and businesses. To achieve that objective, he has proposed a two-part transportation funding strategy that involves, first, the leasing of the Pennsylvania Turnpike under a carefully crafted set of operating and financial conditions, and second, the imposition of a new gross profits tax on oil companies that do business in Pennsylvania. This tax would be dedicated to mass transit funding, and it would exempt companies paying it from having to pay the state's corporate net income tax. Oil companies benefit from a sound transportation system within the Commonwealth. That benefit is partially reflected in their increased profitability over the past few years, and really before that. In fact, oil company profits have increased an average of 13% per year over the past 9 years. Although oil company profits have increased dramatically in recent years, only a small portion of those profits have been subject to Pennsylvania's corporate net income tax. Like other large corporations, the oil companies have been very effective at using all the tax planning devices at their disposal to minimize the amount of tax they have to pay in Pennsylvania. Governor Rendell believes that the time has come to change our state tax policies to give these companies a bigger role in sustaining our state's transportation system. The governor's proposed oil company gross profits tax would be levied on the gross profits of oil companies. It would be imposed on a combined reporting basis at a rate of 6.17%. For the purposes of this tax, gross profits is defined as the total sales of an oil company minus the cost of goods sold, line 3 on the federal corporate tax return. Oil companies subject to the oil company gross profits tax would not be subject to the state's corporate net income tax, once again. At the rate of 6.17%, the tax is expected to generate $722 million in fiscal year 07-08 and $830 million thereafter. Of that amount, $70 million would be transferred to the general fund to make up for the loss of oil company corporate net income tax receipts, leaving a net $760 million annually for mass transit and infrastructure improvements. The gross profit tax would be imposed on oil companies defined as entities that perform exploration, drilling, importation, refining, or wholesale distribution of petroleum products. Petroleum products are any products that contain or are made from petroleum or a petroleum derivative that are used for motor vehicle internal combustion engines and or heating. The gross profits tax base would be calculated for an entire corporate group and apportioned to Pennsylvania based on the total sales of the group, and this would be done to ensure the constitutionality of the tax. The oil company gross profits tax would require oil companies to combine the gross profits of all related companies on one tax return. This would make it more difficult for them to use aggressive tax planning techniques to shift profits and thus avoid the Pennsylvania taxation. To impose a tax on a combined reporting basis requires that there be a clear definition of the taxable group of companies. Our proposal includes a definition of the members of the corporate group that must be included in the combined report. The definition would be consistent with the United States Supreme Court decisions upholding combined reporting taxes in other states. The gross profit tax base differs from the corporate net income tax in that the corporate net income tax base is federally defined taxable income, taking into account all sources of income, less all deductible expenses. Under the proposed gross profit tax, many types of expenses would not be deductible. The gross profit base, therefore, is much broader, allowing for greater revenue at a lower tax rate. The estimated revenue from the proposed tax has been calculated based on national data from Internal Revenue Service statistics of income for companies in the petroleum business. The taxable portion of total gross profits is derived from Pennsylvania's share of national petroleum product sales, which is actually just under 3.8%. In the initial fiscal year of 07-08, only the estimated payments for 2008 would be due, but in subsequent fiscal years, a full year of revenue is expected. The legislation will contain a provision that prohibits a pass-through of this tax to Pennsylvania consumers. Governor Rendell has been very clear that any proposal to solve Pennsylvania's transportation funding crisis must minimize the tax burden on the state's residents. The oil company gross profit tax proposal therefore authorizes the Attorney General to ensure that this tax is not passed on to Pennsylvania citizens at the pump. Some have expressed concern about the enforceability of this provision. State and federal courts in jurisdictions outside of Pennsylvania have ruled on similar provisions. Some have upheld the anti-pass-through provisions and some have not. It is important to realize that none of the decisions in these cases reflect the law of the Commonwealth of Pennsylvania. While it is unclear what a Pennsylvania state court or a federal court sitting in Pennsylvania would do, there is no binding precedent in the Commonwealth that rules out such a protection for the public. Given the concern that some have expressed in this regard, we look forward to working with the General Assembly to craft language that would assure our authority to protect Pennsylvania consumers from any effort on the part of the oil companies to pass the tax on to them. As I said earlier, our economy is dependent on a sound transportation system. As the Transportation Funding and Reform Commission suggested, we need to increase our investment in that system to ensure that it remains a viable, convenient, and efficient transportation option for the citizens of the Commonwealth. In my testimony, I've outlined Governor Rendell's proposal to address Pennsylvania's transportation needs. As the governor is fond of saying, the administration does not have a monopoly on good ideas. We are eager to know whether the General Assembly has other ideas that could provide the needed levels of dedicated funding for mass transit infrastructure improvements in the Commonwealth. The time to act is now, and we are committed to working with you to address this important state need. Thank you for your time, and I'd be happy to take questions.
Thank you very much for your presentation, Mr. Secretary. Keystone of this tax upon oil companies appears to be an idea that we can craft language to prevent the cost of it being passed on to motorists, truck drivers, rail operations, farmers, home heating oil users, and everyone else who depends upon petroleum for their daily lives, business operations. At the press club yesterday, the governor indicated that no Pennsylvanian would pay for his proposed transportation funding. Quote, and I'll quote him, "If you follow my proposal, individual citizens would pay zero for these improvements." Do not Pennsylvanians pay tolls when they use the Pennsylvania Turnpike? Do they pay higher fuel bills when distribution of fuel becomes more expensive here than in other states? Seems to me that there's quite a lot of nonsense in that statement, and it's about time that the governor begins to be honest with Pennsylvanians. There is no free lunch. And if we're going to have mass transit, we're going to have transportation improvements, somebody's going to pay the bill, and I'm not sure it's somebody else, because we all, as I pointed out, pays into this. Do you have any comments on that?
The proposal here is, you're right, at present, the consumer is paying for roads and bridges about $2.3 million, and if the tolling part of the governor's proposal goes through on roads and bridges, that will take it to over $3 billion. That comes out of the consumer's pocket. That's absolutely right. What the governor's trying to do with mass transit funding here is to do something different, and that is to tie the funding to the oil companies and try to make sure that the stockholders of the oil companies, not the consumers of the product, pay for this tax. And that's what we're trying to achieve with this oil gross profits tax.
You stated at the earlier hearing that the governor's support for this proposal is contingent upon the anti-pass-through provisions being included and to be upheld by legal challenges. Is that position still firm?
Yes. There are three basic assumptions underlying this mass transit funding idea. The first is that we really do need to invest in our mass transit systems, $700 to $800 million a year to bring it up to where it should be. The second thing is that the consumers of Pennsylvania are paying 100% at this point of the transportation infrastructure funding, and so that whatever we do, the governor is saying we need to find a way to make sure that this new investment, $700 to $800 million a year in mass transit, is not passed on to the consumer. And his third idea is that again, the oil companies are in an ideal position to partner with the Commonwealth in helping to fund these mass transit investments.
What impact might the imposition of this tax have on oil companies who are engaged in developing alternative fuels as a part of their business operation? Doesn't this tax proposal negatively impact that part of their business as well?
It certainly competes with other uses for cash of these corporations, but exploration and investment, capital expenditure investment is not the only way that private companies use their free cash flow. As an example, last year ExxonMobil invested about $18 billion to $19 billion, just under $20 billion in exploration capital expenditures. In the same year, they used about 25 to 28 billion of their free dollars, cash flow dollars, in stock buyback, and about $7.6 billion in dividends. So it's not clear what the use of this tax money, this cash, would actually compete with. To a certain extent, you could say it might, if it competed across the board, given that proportionate distribution of the use of their excess cash, or ExxonMobil would probably have a bigger impact on stock buybacks and cash dividends than it would on investment in capital expenditures and drilling and exploration. But it's not clear. The thing that I think we're trying to do here is direct a certain portion of that free cash flow in this specific industry to things that they should have a special interest in supporting. And I think that's the governor's intention here.
The question about how this type of tax would impact the supply of gasoline and fuel oil into Pennsylvania will be likely raised by the industry panels that follows you. Have you evaluated the potential impact of this tax on competition and distribution at the local level? For example, if I am an oil company based in Ohio and I have several stations in Pennsylvania that I provide fuel to, wouldn't this tax discourage me from competing in the Pennsylvania marketplace, thereby reducing competition and increasing prices?
If that were to happen, the normal course of events in the free market would be that prices would rise temporarily and then new competitors would come into the state to take advantage of the higher prices. We don't see in a competitive market, which we think Pennsylvania is, that this would crowd out competition or keep people from wanting to compete in a state that is so rich in consumers.
The issue of impact of public transportation on reducing sprawl has been raised throughout the discussion about dedicated funding. What would be your position if this tax, if it were going to be applied to the building materials business because of their role in allowing people to move from core communities to the suburbs? How would you react to that as a business professional, especially if you were told you couldn't pass on the tax without fear of prosecution?
I'm sorry, are you asking how I would react to that in the building products business?
Yes.
Which is what the business I used to be in, right. The ability and my experience, the building products industry and the construction industry, especially in residential construction, is it's a very, very competitive market. And it would be very hard to pass on costs that raise prices beyond the price that people were willing to pay above market prices. That, in my experience, was not an issue we had a problem with in my industry. And especially right now, I think most of my industry would be happy just to be able to recover basic costs in the market. So market pricing in the building products industry, I think, works a little bit differently, where you have lots of actors, lots of competitors, than in the, I think, the oil products industry, where you have relatively fewer competitors, a little bit less competition, and a different system for setting prices. In either case, I think passing on costs to the consumer is not as important as meeting competitive pricing in the market. So I would feel, I think, feel okay with that.
So you were supportive of if we implement this tax, we should do it to other industries, such as the pharmaceuticals. You go down the whole list that everybody should be paying, and all of us who are taxpayers out there would get a free ride.
No, I think that's a good point. I agree with you that there is no such thing as a free ride. I think here, and in the past, the state has targeted certain industries for special partnership in terms of supporting certain public goods. In my industry, it's done more at the local level, but impact fees paid by contractors as they build, levied mostly by local municipalities, might be a reasonable counterpoint to what we're proposing here, in that where contractors are going to build a subdivision, build out a subdivision, create new patterns of traffic, local townships typically, or very often, assess an impact fee on those builders. And I think the builders and people in my industry might, worry about that a little bit, about the size of it, but I think most of the contractors understand the rationale for it and pay it. And I think we're talking about sort of the same thing. Analogies are always a little bit tricky, but I think we're talking a little bit about the same thing here with the oil companies.
I have no further questions right now. Senator Stout?
Thank you, Mr. Chairman. Good morning, Mr. Secretary.
Morning, Senator.
I had the privilege of serving on the Governor's Transportation Funding and Reform Commission. That was 18 rather hectic months, and finally we made a recommendation last fall. And I came to the conclusion the problem with mass transit wasn't funding, it was operations. Because today, the Commonwealth of Pennsylvania contributes nearly $900 million to transit in the Commonwealth, and we came up with the recommendation that they requested they need another $760 million. So what concerns me with how you define this tax and how you're going to have carved out, I've got a number of letters from my constituents that are concerned, since they have natural gas wells drilled on their properties, that they're being advised that the income that they generate from having natural gas produced on their property, that they will be subject to this 6.17% tax. Would you please elaborate on that, sir?
Yes, and thank you for asking that question, because you and I had a conversation yesterday, and I think I might have given you some imperfect information. Natural gas is not counted in petroleum products for the purpose of this tax. So there is no question. Propane is part of the petroleum products tax, but not natural gas.
So people that have their homes heated and fueled by propane would be subject, the people that deliver propane would be subject to this tax?
Not if they're in the retail business. This does not go down below the wholesale level. So a retailer of propane gas, a retailer of heating oil, would not be subject to this tax.
Now, I know you've had a short time to look at this issue, but my understanding is that petroleum refining companies import a significant portion of their resources offshore, that they have a special tax write-off through the federal government on the taxes they pay offshore. Would that have some impact upon the on this proposed tax in Pennsylvania, that they could write that off some way?
I'm not sure if that gets written off as part of cost of goods or as an expense that goes against their net profit. Again, when we calculated this gross profits tax, the estimate that we used was really just looking at the companies that were in this sector of the industry as defined by the Internal Revenue Service, and then taking their tax returns and summing them up. The tax returns taking line 1, which is revenues, gross revenues, minus line 2, which is the cost of goods sold, however that's defined in the industry, and line 3 then is the resulting gross profit. That's the line which I think in the year we looked at it was about $326 billion for companies in the United States, and we estimated from that about 3.8% of that $326 billion would pass through Pennsylvania in one form or another. Again, I don't know whether the different techniques for amortizing costs, exploration, drilling, and credits at the federal level actually are applied against their net income before taxes or their gross profits. So that's a good question. I can get back to you on that.
I'd appreciate it if you would. The other thing, I was here in the 80s when we passed a thing called oil franchise tax.
Right.
And that oil franchise tax dealt with the wholesale price of fuel. And several years ago, when the base was increased, it could be done once a year under the federal definition of wholesale price, and that generated to PennDOT additional nearly $300 million. It's equivalent to about 3.8 cents of gas, and no member of the General Assembly had to put up a controversial vote, and that was passed on to the customer at the pump.
Right.
It was called the oil franchise tax, but ultimately the price was paid at the pump by the consumer. So would not that same type of what happened with oil franchise could be happening to this gross profit tax?
That's what we're trying to avoid. You're right. I think the original intent, you would know better than I, but I believe the original intent of the oil franchise tax was to prohibit the pass-through to the consumer. In the end, I don't think that ended up being part of the bill. So, in fact, along with the other pump volume taxes, essentially ended up being passed on to the consumer. We're trying to do it differently here, and so that's the distinction between. The intent is different here.
All of us represent different districts. I happen to represent a district that borders on West Virginia and Ohio. And to follow up on Senator Madigan's question, if it's not as profitable to sell fuel in Pennsylvania, it would be more profitable for me to fuel my stations across the line in Ohio and West Virginia and reduce job opportunities in Pennsylvania, and for them to, instead of allocating fuel to Pennsylvania, it would be more profitable for them to allocate fuel in New York or Ohio or West Virginia. How do we prevent that from happening?
I might be wrong, but I think the market would take care of that. The market would clear at the price that would, you'd have supply and demand meet. And if the prices were higher in Pennsylvania than they were in West Virginia, I think you'd have suppliers move into Pennsylvania to take advantage of those higher prices.
Well, I've heard from many of my constituents who are in the fuel distribution business think that if this tax were imposed, it would seriously harm their business. They wouldn't be able to compete because they have to compete with these fuel distribution concerns in neighboring states.
Again, if we're successful in ensuring that the tax is not passed on to the consumer, the price should be the same. If the price goes up because suppliers move out of the state and reduce competition, I think that there will be other suppliers who will move into that vacuum. Again, there are two different issues here. One is, will the 6.17% be passed on to consumers? And if that's not done, then that won't be a source of the higher price. Your question is, if the higher price comes not as a result of that, but as a result of less competition, if that's the source of the higher price, then I think the market forces would go to work on that. So if I'm understanding your question, I think that...
Well, I'm sure that's going to be a concern of the members of the General Assembly. Last question, Senator Madigan tried to identify the type of fuels that this tax would be applicable to. Now, we have 2 or 3 plans in the Commonwealth to locate ethanol plants and biodiesel. Would fuels produced by ethanol or biodiesel be subject to this tax? Because they're an energy source.
That's a good question. Could I turn this over to Deputy Secretary Dan Hassel?
I'm thinking about your question, Senator, as I understand the language. There is a definition of what is an oil company in the legislation, and if a company meets the definition of what is an oil company, then their gross profits will be subject to tax. And that definition has to do with exploration, drilling, refining, and wholesale distribution of petroleum products. And I believe that I don't know enough about how those kinds of companies that you're referring to that operate as in the biodiesel business or in the ethanol business about exactly how their business is structured and what kind of products they sell exactly. We might need to look at those to better understand how
Well,
that
for
how
your
that works.
information, the ethanol industry is more related to the moonshine industry, because its feedstock is grain, either corn or other grain, and so there's no drilling or prospecting for, like you do for oil.
I understand that. I guess I was thinking that at some point there will be a blending operation of mixing those products with petroleum products.
Well, the
And
governor's
where that
advocated-
occurs.
The governor's advocated that we support that ethanol industry to create job opportunities and make us less dependent on foreign oil, that we have an ethanol industry in Pennsylvania. And I understand up in Schuylkill County, there's plans to create a ethanol plant that would take corn, and there's other feedstocks, such as from all types of switchgrass and other type of foliage and so forth to fuel that. So that concerns me as we try on one hand to reduce our dependency on foreign oil by creating ethanol and biodiesel. Now we're going to handicap it further by adding an additional tax on that product.
Why don't you let me get back to you with a good answer to that, because I think that's a great question.
Okay.
I'll just add, I guess, that, excuse me, those products, the biodiesel and ethanol are not petroleum products, and so by themselves, they would not trigger this tax. I guess the question that I have in my mind is that at what point are they blended with regular fuel, and that's what I think we would need to investigate.
Well, thank you, Mr. Chairman.
I think one thing, Senator, we can say for certain is that the moonshine industry would be unaffected by this tax.
We still have that in southwestern Pennsylvania.
Thank you for bringing us up to date to the moonshine. I think that's important. And to the discussion we have, Senator Earl.
Thank you, Mr. Chairman. Good morning.
Morning.
To some extent, I just want to note that I know that you were not around at the time that this proposal was probably devised, and now you're kind of on the hot seat in terms of having to defend it, and I do have some sympathy for you in that regard. And as we have talked privately about this, I think there's probably one thing that we agree on, and that's that we have a very serious funding issue with regard both to mass transit as well as to our bridges and highways. And I think everyone in the General Assembly recognizes that fact. I find it very disheartening, though, that the administration has now put forward this proposal, which I find to be just incredibly disingenuous in terms of actually getting enacted, even if we agree that it's constitutional, which we clearly have many differences of opinion about that. But I think that it's unfortunate that by the time this proposal probably dies its own slow death, we will have done nothing to address what is really a very serious issue. And I find it extremely disheartening, once again, that the governor says, well, here's my proposal. If you don't like it, find something better to put on the table. To me, that's not leadership, and he does it continually. Getting to the question of whether this is constitutional, first of all, you would agree that there are many differences of legal opinion as to whether this tax is constitutional or whether it violates the Commerce Clause. And I would point out that we've had a hard time even vetting this proposal, considering that we didn't even get the written legislation until quite recently. But to the extent that it has been vetted, there is a legitimate difference of opinion that would ultimately result in litigation that would not be finalized anytime in the near future in order to get funding from this source to deal with this problem. Do you think this proposal is constitutional, and how do you get around the Commerce Clause?
I think two things. You're absolutely right that the rulings are few and ambiguous at this point in terms of this kind of legislation, especially as it affects the pass-through part, but also the uniformity part. But we, at this point, feel very comfortable in defending it against appeal if it were appealed.
But you would agree that's going to cause some significant delay, even if the outcome were favorable to you,
It might. Now, it depends, I guess, in terms of what delay. It depends on whether the companies pay this tax right from the start on schedule and appeal having paid the tax, or whether they get some injunctive relief that keeps them from having to pay, in which case the state would have to find some way to front that money either through reserves or through borrowing.
But just
you're
the
right,
uncertainty of whether there would be a requirement that they have to pay the tax up front while the litigation proceeds is still not going to, even that question is not going to be answered in a timely enough manner for us to be seriously debating this as part of the 07-08 budget.
My understanding is that the presumption would be that the tax would be due when when we put this in place, which is January 1st, 2008. Again, there could be injunctive relief to anybody appealing this, but the assumption is that it would be payable and due the first payment around March 15th of 2008.
I think it's an interesting dynamic that our own Attorney General, who would have the task of actually defending this legislation if we were to pass it, himself has issued an opinion that he doesn't find that this tax is defendable. But putting all of that aside, I'm also intrigued by this continual suggestion that this is not going to be passed on to the consumer. And even in light of your testimony this morning, if there was some way that you could prevent it from being passed on at the pump, ultimately, because this tax will be a disincentive to new investment, to companies coming into Pennsylvania, we're hampering the competitive marketplace by taxing this product. You yourself suggest that will drive up prices ultimately. So ultimately, the consumer is going to be paying more, whether it's directly as a result of this particular tax or whether it's because the tax increases the price at the pump because of little investment that's going to take place in Pennsylvania. So I think it's also, once again, very disingenuous to be out there suggesting that to the consumers that there is, in fact, a free lunch when it comes to paying for transportation costs, that we can impose a tax that they're not going to see any effect of. I mean, it's just clearly not accurate.
Well, let me push back a little bit on that. I think that there are taxes that don't get passed on to the consumer. A net profit tax is one that's very difficult to get passed on to the consumer. It is borne more by the stockholders of the company. And the effort here has been and obviously at the other extreme would be the consumption taxes, sales tax, business use tax that is explicitly passed on to the consumer. What we've tried to do here is create a tax that is far enough up the chain toward the net profit tax end of the continuum so that it is not mechanically as easy to pass on to the consumer as obviously a sales tax would be. So the hope is, and we're still, I still believe that we can achieve this, that mechanically and legally we can keep this tax from being passed on to the consumer. Again, the question on the higher prices, I thought, as I understood it, was being driven by the reduction in supply because some companies would use that as a reason to move out of Pennsylvania so that reduced supply might mean less competition and higher prices just in the marketplace. On that side, I think the market would end up by bringing prices back into the competitive equilibrium with other states. Again, the key here is who. So the question is really who pays this 6.17% tax, and the choice is that the consumer doesn't ultimately pay that, or no one pays it. I think it's either the consumer pays it or the shareholders of the oil companies pay for it. What we're trying to do here and what the governor is proposing is that in this case the shareholders of the oil companies pay for this tax, not the consumers. That is theoretically possible, and that's the hope here.
Well, I think that there is certainly wide divergence of opinion as to whether that's a legitimate economic theory and whether that's really what's going to prove to be true here. Let me ask you a specific question. About $200 million of gross revenue from oil and gas production were paid out in at least 05, 06 numbers were paid out as royalties to private landowners. Are these private landowners now considered oil companies under your definition?
No, they're not.
So those royalty-type payments wouldn't be taxed in this proposal?
No.
Well, I will pay attention closely as this proposal continues to be vetted, but I suggest that everybody be thinking about a Plan B, because we're still at the end of the day left with a very serious funding problem that I just don't think is going to be resolved by this proposal.
Thank you.
Thank you, Senator Earl. Senator Pippy.
Thank you, Mr. Chairman. It seems this line of questioning is all going back to the same concept as a theoretical possibility of taxing a company and not having that go down to the consumers. When we asked the Attorney General about this during the budget hearings, I think he said that he doesn't see how this could be done, that we just can't separate. What would stop, if we were successful, which I don't think we will be, but if we were successful, what would stop every state from doing this? And then what would that impact be on the price of gasoline in our country as a whole, or in the Commonwealth of Pennsylvania?
Again, this is a good question. I think it gets back to Senator Earl's issue as to who actually ends up paying this price. If you prorated the $800 million that we're looking for here in this tax in this state and extended it to the rest of the country, you'd be talking about a tax bill for the oil industry collectively of about $21 billion. That's about what it would equal if everybody were paying this in every state. Again, the decision that price makers, the price setters within each of these companies have to decide is, where is that going to come from? And again, the choices are, it could come out of the consumers' pockets, it could go into higher prices, or it could come out of lower dividends, lower stock buybacks, or lower investment in exploration and drilling. There's a whole host of options open to those who are looking to fund this tax. So I understand the sensitivity to this and the complexity of who actually ends up paying for this. Again, the objective here is to shield the consumer, in this case, in this one case, from this tax to fund mass transit in Pennsylvania.
I understand the intent is to shield the consumer, but many of us believe that will be very difficult to do. And looking at $800 million, that's roughly a 12-cent gas tax at a minimum, and potentially going higher if other states were to follow the lead. If the Attorney General doesn't come back with any type of legislation or recommendation to protect the consumer, will the governor go forward with this proposal? And if he does, will he start telling the people this will be a 12-cent tax on gasoline?
At this point, we're all expecting that this will not be a 12-cent tax per gallon on gasoline. And we're working, the Revenue Department would be obliged to come up with an audit system that would allow us to determine whether the tax was in fact being passed on or not.
It seems like we need a lot more detail on this proposal, or any proposal like it, and it goes back to the point that Senator Earl just said. I don't see this helping us with the mass transit problem when they're talking about running out of money again by the end of this calendar year. So what is the other options besides this, or has there been any thought for a Plan B?
No, this is our Plan A and B.
Okay. Thank you, Mr. Chairman.
Thank you, Senator Laval. No questions. Senator Williams.
Thank you, Mr. Chairman. Ladies and gentlemen, in full disclosure, as you may know, I have the privilege of knowing a great deal about the oil industry and of having a family interest in it as well. I have a couple of questions on the tax returns and the tax forms. So you say the tax will be on the profits less cost of goods sold.
The revenues.
Revenues less cost of goods sold. And that would be, in general, before interest and taxes, as we just discussed. The tax, would this tax that the oil companies would pay in Pennsylvania be deductible from their federal taxes?
Yes, that would be my expectation, just as the corporate net income tax is currently deductible for federal purposes.
So have you looked through a scenario of how this would, an example company and how this would actually impact their bottom line?
We haven't looked at it on a case-by-case basis, but the relative impact versus the 9.99% Commonwealth corporate net income tax, it would vary depending on how mathematically the relationship between the ratio of the net profit to the gross profit. For example, if the net profit is 61.7% of the gross profit, the tax would be exactly the same and would have no impact on federal income. It would be the same either way. Chances are it'll be lower than that, in which case it would be a higher deduction for federal tax purposes than the corporate net income tax.
Do you know, can you give us the number of companies that do not pay the corporate net income tax in Pennsylvania at this time, and how this tax would affect those who are not currently paying a corporate net income tax?
I don't have that figure for the oil industry. Generally, 73% of C corporations in Pennsylvania at last count did not pay any corporate net income tax.
I mean, I think we, as Senator Earl said, I think we have a terrible crisis in Pennsylvania on how we're going to fund our mass transit. I'm just not convinced this is the way. And I think the concerns that have been brought up by some of my colleagues as well is, how are you going to know that the increased tax is, or this tax is not going to be passed along? How are you going to track so many of our, especially in the gasoline business, have express stores with them, which, you know, are great money makers. That's where there's that's where the margins are, I think. That's why they have them. How do you know that it's not going to be increasing the cost of the goods sold there? That's one thing. And also, I think that it is knowing, if you have 4 gas stations on a corner, they're going to compete with each other on the price of the gas. It doesn't matter what's happening a mile down the road. If one, they're going to try to get the lowest possible, unless there are no stores, no other competition there. And when you have some of your companies which are operating on much smaller margins, will pull out. And then, so I think it would be very difficult to see the impact of competition lowering the prices if there's no competition. I think these are difficult times. This is a very difficult proposal the governor has produced, and I think we need to have a lot of answers that we don't have. So thank you for sitting in the hot seat today. Thank you.
Thank you, Senator.
Thank you, Senator. Senator McElwain.
Just one question, Mr. Chairman. In your testimony, I didn't see any discussion about some of the other states specifically, and I was wondering if you had looked into the situation in Alaska where they actually imposed this tax about 3 years ago but have yet to collect it, and if we would be facing any of those same pitfalls. And I say that because the worst thing I think that could happen is if the governor does manage to impose a 12-cent tax on the people of Pennsylvania, and then we can't collect it, that's going to put egg on all our faces.
No, I have looked at some of the experiences in Alaska, but I can't say that I know what they've done or what they haven't done. We've looked at court cases in New York, Alabama, and Puerto Rico in terms of the legal options we have, and again, the precedents that or the basis upon which possible appeals might be made. But I'm not as familiar as I should be with Alaska.
I guess I would just make the comment that we really should take a look at what they did in Alaska 3 years ago and why they still haven't collected any revenue from that tax to make sure we're not going to go into that same situation if this issue was to move forward at all. Thank you, Mr. Chairman.
Thank you. I have a couple follow-up questions. You presented in your testimony that the average over the past 9 years has been 13% increase in oil company profits. Can you tell me what they were in 1998?
Not off the top of my head, no. I don't have that here. Maybe, do you have that? I'm sorry, can I get back to you with that?
Would appreciate it, because at that point, oil was $10 a barrel, and today it's 60-some. So the other standpoint, you point that the impact of this tax on companies is going to be that the value of their stock, the value of their shares is going down. What's that impact going to be on our state pension systems? The PSERS as well as Sears, who have large holdings of the big bad ExxonMobil.
I don't know what the impact would be, and I don't know what the percentage of their portfolio is in oil company stocks. We didn't look at that.
I think this is something that we need to know before we put another fear into our pensioners who count on those incomes, and potential impact, and I don't know offhand what they are, but I know they are significant in their holdings because of the dividends that they have produced over the years. So that's something I would like to find out. And I guess my final question is, are you confident that your accountants can outdo the accountants with all of the major oil companies?
That's a good question. I think it gets back to Senator Williams' question, too. How do we identify cause and effect here? And I think the Revenue Department understands that it would have to develop new audit systems to look at this. In talking to our folks, they see a parallel in terms of some of the things that the IRS does in terms of transfer pricing, in terms of auditing transfer pricing issues at the federal level. We would have to look at probably individual pricing decisions. I mean, we recognize that gross margin and pricing is established and set by more than just the conscious decision to raise a price. Product mix makes a difference in the gross profit margin that a company enjoys. Cost of production, cost of goods makes a difference in some cases in the prices that companies charge. But I think we could we could develop an audit system that would probably be based on looking at individual pricing decisions on individual items, looking at magnitude and direction of those pricing changes, again, on a product-by-product basis, and somehow, again, along the lines of the IRS on transfer pricing issues, figure out a way to come in and make sure that is not being passed through to the consumer.
I think that's a question that has to be answered. I think members of the legislature certainly have to be confident that it will not be passed through, and if it is, where do we go? One final question, and it's a little bit away from this, but I think it has a major impact. We have looked at the other part of the governor's proposal is the sale of the turnpike, or leasing of the turnpike. Senator Stout and myself were in Washington with a number of other states meeting on P3s, and at that conference a statement was made by one of the financial advisor companies that if we fail to move ahead with privatization, that what we have to look forward to in the future is $7 a gallon gasoline. And be frank, I didn't follow up with him, but that individual made it to me in a private conversation and in that public forum. And that's kind of scary. And maybe this is the way to go if that's where the price of gasoline is going.
Well, or it could be that mass transit is building mass transit not as a substitute, but as a viable alternative to automobile and truck traffic. I think that might make a strong case for that as well.
And I guess my concern, too, with this proposal is that it lets the locals off free. They look to the state to provide all of the funding for mass transit.
One of the things that's a good question. I think that one of the things, the assumptions underlying this proposal is that the local authorities would follow through on the recommendations of the commission report and make a contribution either by streamlining operations, becoming more productive, but and making bigger contributions to the upkeep and maintenance of mass transit systems. But this is, what we're talking about here is a state contribution based on local effort as well.
Thank you. Any further questions? If not, thank you very much for sitting in on the hot seat this morning. Thank you.
Thank you, Mr.
Secretary Wolf.
Thanks, Mr. Chairman.
We'll now call up our fuel distribution petroleum industry panel, and I will first swear you in, and I'll allow you to introduce everybody, and I won't. Do you swear that the testimony you're about to provide is the truth, the whole truth, so help you God? Thank you. I have Rolf Hansen. Are you the lead off? And I'll let you introduce the members of your panel, or if you want to do it individually.
My name is Rolf Hansen. I'm the Executive Director of Associated Petroleum Industries of Pennsylvania.
And I'm John Felmy, the Chief Economist of the American Petroleum Institute in Washington, D.C.
I'm John Cooley. Good morning, Chairman Magnin, Chairman Stout, and members of the committee. As I stated, I'm Rolf Hansen, Director of Associated Petroleum Industries of Pennsylvania. We are a division of the American Petroleum Institute based here in Harrisburg, and our trade association represents more than 400 companies involved in all aspects of the oil and gas industry. I really welcome this opportunity today to have a chance to provide our views on this issue. Over the past few weeks, we've heard a lot of debate on it in the appropriations committees and a lot of questions that have been asked, and hopefully with the panel provided you today, we'll be able to provide some answers for you. And I'd just like to start off by just keeping something in mind as this issue is being debated, and that's that our companies can continue to provide energy. We're energy providers, and the energy consumption in this country increases every year. The Department of Energy Information Administration predicts that the world oil demand will increase by 47% from 2003 to 2030. New oil reserve discoveries are likely to be smaller, more remote, and more costly to bring to production. And since we have the presence of our chief economist here with me today, I'm going to keep my points to a minimum so as not to be redundant, but there are a few points I'd like to highlight. And the first is higher taxes usually result in higher prices for consumers, reduced earnings for investors, or a combination of the two. Taxes, not unlike amounts paid for raw materials and employee salaries, are a cost of doing business and are ultimately reflected in the price paid by consumers for a company's products. Secondly, during the Carter administration, there was imposed on a federal level a windfall profits tax on the oil industry. It was a bad idea then, and it would be even a worse idea today. The governor has repeatedly made the statement, and the question was asked earlier today, that the nation and Pennsylvania needs to become less dependent on foreign oil. Yet this policy does the contrary. The Congressional Research Service did a report in 1990, which was just updated again last year. And what they found is that when that windfall profits tax was imposed in the industry in the 80s, that the United States became more reliant on foreign oil, as much as up to 13% more reliant on foreign oil, because it took the money that would be used for domestic production and investments in domestic capacity and was diverted away in the form of a tax. Thirdly, the report also noted that the windfall profits tax destroyed jobs. According to the study, between 1982 and 1988, the industry lost about one-third of its jobs. We've heard on numerous occasions today that the administration, the intent is to have the stockholders pay for this tax, not the shareholders. Well, I can't stress enough that stockholders and shareholders are one and the same. 41% of oil company stocks are owned by public pension funds, including SERS and PSERS. Just doing some initial research, there are over 15 major oil companies in PSERS' portfolio. The Teachers Union, their second largest holding of common stock in value is ExxonMobil Corporation. So taxing the profits diminishes the returns to these pension funds, 401ks, retirement accounts, and those are your consumers. So not only are they paying the tax, but they're getting it on the other end as well, as far as diminished returns. There also has been a lot of conversation regarding the pass-through provision. Since this tax would be, as far as we can tell, a first of its kind, there hasn't been any direct case law to apply to this. But some lower courts have made decisions on this, and the one that I would refer you to, it's in the testimony, is in 1983, Shell Oil Company versus the New York State Tax Commission. And the court held that a gross profits tax with a provision prohibiting oil companies from passing on the cost of the tax to consumers of New York violated the Commerce Clause. The court found that the effect of the pass-through prohibition would be for oil companies to recoup the cost of the tax, the New York tax, from non-New York taxpayers. And because that prohibition would shift the direct burden of the tax from companies that operate New York customers onto their out-of-state customers. And as a result, the New York legislature repealed the law. As I pointed out, Governor Rendell's proposal to tax oil company profits will dramatically impede on the oil industry's ability to continue to meet consumer demand for petroleum products. It will tax away the earnings of those invested in public-private pension funds, retirement accounts, and usually results in higher prices paid by consumers. And with that, I will conclude and digress to our chief economist, Mr. John Felmy.
Thank you very much. Chairman Madigan and Chairman Stout and members of the committee, I am John Felmy, Chief Economist of the American Petroleum Institute, a national trade association representing all sectors of the U.S. oil and natural gas industry. We have about 400 member companies. Thank you for the opportunity to provide testimony on the governor's proposal to impose a new tax on the petroleum industry. I am especially thankful to be here because I am a native of Pennsylvania, born in Clearfield, got a high school degree from Jersey Shore High School in Lycoming County and 2 degrees from Penn State, so I view this is a very important issue, and I appreciate the opportunity. We don't believe this substantial new proposed tax is justified. We don't believe it would be good for consumers or for employment in the state or for Pennsylvania retirees who rely on pension funds that are invested in oil companies. Its no pass-through to consumers provision may be unworkable or illegal, and I can reflect on the unworkability later on. And it could require significant additional state resources to administer. The tax proposal appears premised in part on the idea that oil companies make too much money. This is neither accurate nor fair. It is no secret that the financial performance of oil companies has improved. Back in the late 90s, crude oil prices were as little as 1/5 of what they are today, and pump prices dipped below $1 a gallon. In fact, in 1998, gasoline prices, when adjusted for inflation, were the lowest in history. Too often during the 90s, returns on investment and profit margins for the oil and gas industry were unimpressive or disappointing and far below that of other industries. While the industry is doing significantly better today, the large profit numbers reported in the media are misleading. First, the raw earnings of the industry are large because the industry is massive. It provides U.S. consumers about 880 million gallons of oil products, including gasoline, every day. It also must spend huge sums to explore for and produce energy that consumers expect to be available in the future. These investments dwarf the company's net profits. Second, earnings on the dollar for the oil and gas industry have improved from low levels to about average levels. For the first 3 quarters of 2006, the oil and gas industry's earnings averaged 9.4 cents on each dollar of sales. The average for all manufacturing industry, excluding the financially distressed automakers, was 9.6. Consumers are paying more and understandably would like to pay less. We've all grown accustomed to affordable energy, which enhances our standard of living and spurs business development and job creation. But the key to moderating prices is not taxes, because that would discourage investment in new facilities and new oil supplies, and also investment in new energy technologies. If we want to put downward pressure on prices, we should be increasing supplies relative to demand, not making it harder to increase them. This is not just economic theory. History teaches us that isolating the oil industry with unwarranted taxes can diminish domestic production and heighten reliance on external supplies to meet demand. The Congressional Research Service estimated that U.S. oil production fell by 1.2 billion barrels as a result of taxes imposed on the industry under the Carter administration. As domestic production suffered massive cutbacks, oil imports surged by 13%. Also, thousands of industry jobs disappeared. This is the wrong model for Pennsylvania. It is also at odds with the governor's recent call for a boost in Pennsylvania energy production and his acknowledgement of the importance of the oil industry manufacturing jobs to the state. Before leaving the issue of supply, I want to emphasize one point. Oil companies will continue to serve Pennsylvanians, but a tax that reportedly will have anti-pass-through provision would be a disincentive to expanding operations and supply in Pennsylvania as the state's economy grows. Please ask yourself this question. Why would investors rush to put available capital into new oil and gas businesses or expanded businesses in Pennsylvania when the state plans to tax away higher profits while surely leaving the industry to fend for itself should its financial performance worsen, as it often has in the past? Would you invest in an industry operating under such a discriminatory, burdensome regime? A principal selling point of the new tax is that it would not be passed through to consumers. Please put a big question mark by that. Not much explanation of this how this would happen would have been given, and there are many skeptics, including the state attorney general, as was discussed earlier. The fact that other states have not imposed a non-pass-through tax may indicate that other minds have considered and rejected the idea because they don't see how it could work. Besides the potential for consumers being affected, Pennsylvanians could be hurt in other ways. 500,000 Pennsylvanians depend on retirement and pension funds invested in oil companies, that's state and local pension funds. By weakening oil company holdings, the governor's proposal could jeopardize payments to retirees. According to a report prepared for Investors Action Foundation, public pension funds providing income to Pennsylvania's firefighters, teachers, police, and other municipal employees contain oil company stocks. The Pennsylvania State Employee Retirement System holds more than $205 million in oil company stocks. The proposed tax could also hurt many Pennsylvanians invested in 401ks and IRAs, often also contain oil company stocks. You've heard of the win-win proposal. Well, the governor's tax could become the new archetype for the lose-lose proposition. It's hard to find winners here. This administration has proposed taxes aimed solely at oil companies before. Why not the thinking might go? Who is going to stand up for them? How many votes could be jeopardized? But if this is the thinking behind the governor's proposal, it is not taking the long view, nor is it fair. Singling out one industry for new taxes is wrong. More important, it usually hurts others outside the industry, in this case, most Pennsylvanians. And it is the wrong strategy for a sound and secure energy future. For all these reasons, we urge you to reject the governor's proposal. Thank you. This concludes my remarks. I'd be happy to try to answer any questions you might have.
Lubricants, propane, to retailers, businesses, schools, farms, utilities, manufacturing, commercial entities, homeowners, and the general motoring public. Most of our members operate second or third generation family-owned businesses. It can be accurately be stated that between our terminal operators and transport fleets, our members represent the backbone of the petroleum distribution system in Pennsylvania. We provide the committee with some charts. I'm not going to go over these charts at this meeting, but just to help you give a picture of how complicated the distribution system is. And actually, in one of these charts, in motor fuel distribution, it shows the refineries and crude owners at the top. And in the middle, literally, are our folks who deliver from the refinery operations to people across the state of Pennsylvania. The first question and so what I want to emphasize here is that we do not represent the refiners or the major oil companies. And our first question that came up when we heard the budget address was what the definition of the administration was going to be of an oil company. Now, I genuinely believe that the governor's intention, and based on his discussions across the state, are to tax the refiners, the major oil companies. However, in all due respect, in discussions we've had with the Department of Revenue and our own attorneys, it's pretty clear that the draft, all of it, at least we saw yesterday, includes much more than the refiners. It includes our class of trade if that person distributes on a wholesale basis to another, reseller of petroleum. You notice I said more than gasoline. We said heating oil, manufacturers, all sorts of petroleum flows in this state beyond just the gasoline that you see on the street. Now, the difficulty that I'm told, I'm not an attorney and will be certainly happy to provide tax experts to you from our perspective, is that wholesale distributor is included in the definition. And simply stated, we have a uniformity clause in Pennsylvania, and what we've been told by the Revenue Department is to call a major oil company, whether it be Exxon or BP or whomever, if they're, in some cases, all these companies do is distribute within Pennsylvania. So to differentiate between that kind of distributor and the kind of distributor I'm talking about apparently runs afoul of the Constitution. So to make it very clear, if I leave you with two thoughts. The first thought is that this tax, as drafted, does include a large segment of locally owned Pennsylvania distributors, not just the big major oil company refiners. Now, I had a little bit of a head start in trying to figure out how this would impact on us because we were shared by the Revenue Department, frankly, with the basic, the percentage and the gross profits that you heard. So we asked our people to take a look at the gross profits line, which is line 3 of the IRS Form 1120, which is the corporate form, and take 6.17% of that. Now, I will stand corrected if I'm not understanding this part correctly. This just isn't the portion of the business that's a wholesale distributorship. In other words, if one of our folks in southwestern Pennsylvania owns a company that distributes to maybe 10 of his own service stations and maybe 20 other individual dealers that aren't part of his business, he's a wholesale distributor. That profit line on the IRS form doesn't say your oil sales. It says everything they sell within that company and their gross profit, whether it be the stores or whether it be their profit from selling heating oil, which isn't taxed in Pennsylvania to this point, or any other gross profit has to be included in that line. So the answer we got back from some of our folks in our sort of informal survey was, some people laughed and said, come take the keys to the company. Because basically 6.17% of the gross profits at our end of the distribution system, meaning not crude oil, not refineries, just our end of the distribution system, which works on very small margins. People throw out 2%, maybe on a good year, 3%. If you're taking 6.17% of the gross profits of that company, it's not, you don't have to be an economic PhD to understand that strangles the company as you go forward. Now, obviously, there's people, everybody's going to be in a little different position on this, but the general across the board, simple 6.17% of gross profits would have a crippling effect on the distribution system in Pennsylvania. And again, I do not believe the governor or even the Revenue Department intended, and all the discussion here has been geared towards the refiners. It's not surprising that a tax geared toward multinational corporations applied to Pennsylvania businesses would have the effect that I'm describing. Now, one of the selling points of the administration's plan, assuming that these companies would still be in existence as time goes on here, is that the plan, we heard the debate, and I'm not an attorney again, but it's the discussion about it being passed on to consumers. Well, first of all, our people, in all due respect to my colleagues, our folks have dealt with the major oil companies for 20 or 30 years. They do not believe for a minute that there won't be a way found to pass on some of the costs to them as the in-between companies. Now, how you describe, and I agree with the API folks, how you then ascertain from there on a given daily basis what's impacting the price of gasoline or any other fuel, I think is extraordinarily difficult. The second part, besides maybe I should just stop there, because but I do need to make another point about supply. In many parts of Pennsylvania, our people grew up, their businesses grew up, some actually started out by delivering coal back in the 50s, and then when that started going out, being phased out, they went into petroleum. But typically, the further away you got from the major cities is where the distributor network became prevalent. Whether it be, up in the north-central part of the state, or even more and more southwest Pennsylvania becoming dominated by distributors in terms of the network. So we're not talking, when I raise the red flag that it's affecting that network, we're talking serious impact. If companies go out, if they just can't compete anymore, if they just get out of the business, that in itself will have an effect on price. Because we are, and even now, many of our members do distribute what's called unbranded product, not just the brands that are the major oil companies. But you take anything out of the street, if you're just talking about gasoline, just one or two locations, that has a tremendous impact on the small towns across the state. And if you're talking then about adding these costs to heating oil and everything else indirectly because of distributorship, I don't have to paint the picture any more than that, I don't believe. But if we're talking about supply, some of the discussion here was in terms of the structure of the tax itself. I put in my testimony that, and I'll use western Pennsylvania as an example, southwest Pennsylvania particularly. You have a situation there where in the summer, that corner is an island because of the environmental requirements, RVP gasoline. And when I say an island, it's because West Virginia and Ohio around us don't have that requirement, so they can just use conventional gasoline, as it's called. I can tell you, every Labor Day when it's come to the end of that season, fortunately it hasn't come to the attention of the legislature, but there's always a supply tightening because the refiners aren't making that much product anymore, and we've had some close calls in southwest Pennsylvania, and I give credit to the Rendell administration for helping in a couple matters to make sure that product continued to flow. But what constantly happens, not just in that kind of situation, there's constantly product being taken from Pittsburgh if suppliers can get it, like our types from Ohio can get it cheaper in Pittsburgh from the terminals there and take it to Ohio. That goes back and forth all the time. And so the description about price being higher in Pennsylvania attracting competitors, I think probably a more precise description should be what the return on the investment is. If you're taking 6.17% out of somebody's profit, where is the product going to go, particularly when things get tight? And our folks, frankly, are concerned about, they have supply agreements that go from year to year in many cases, and really, what's the value of that going to be in a situation like this as well? So I'm not here because I don't own the product. Our people do not own the oil. They do not own the gasoline. They don't own the heating oil. We're just suggesting, as the people that do deal with your constituency most directly, raising another flag about ultimately what the indirect supply implications could be here. There's just a couple more thoughts I'd like to leave you. Senator Stout brought up the ethanol. Members of our organization, again, not the major oil companies, have been pioneers in this state, a number of them, in leading the charge to alternative fuels. making the investments into biofuels, making the investments to what has to happen with ethanol. Now, ethanol cannot be piped in like oil. That's why you're talking about ethanol plants being built in Pennsylvania. It has to be handled differently. It can either be railed in, or if time goes by, you get more plants here. But it needs to be stored near terminals in order for it to be blended with regular petroleum in order to have our vehicles work, basically. Those same people that would get hit hardest by this tax in terms of sheer numbers, because they have so much product going through these terminal operators and so forth, that's who I think an administration's plan for renewable energy, those are the people that are expected to make the investment to upgrade the terminal system and create rail systems and so forth. And in all due respect, you're sucking that potential investment out of this system right when you're hoping to start building this renewable infrastructure. And again, that was not the intention, I'm sure, of the governor or the administration, but that is one of the net effects of this. So it definitely will have an impact in answering Senator Stout's question, and ultimately how quickly we can move in that direction, if we move in that direction at all, just based on this tax. Just leave you with the thought. I think we have hopefully made our points. The one thing that I would indicate, that there might be a temptation to pass this tax. Let the courts decide, and if the courts decide against the Commonwealth, the money comes back to the companies, our folks will not be around to get that refund if this tax is applied the way it is described in the draft. So with that, thank you.
Good morning, Senators. My name is Steve Rhodes. I'm the president of the Pennsylvania Oil and Gas Association. I represent the independent producers and the related companies that produce the Commonwealth's indigenous crude oil and natural gas reserves. The industry consists of a couple hundred companies operating in 31 counties in western, central, and northern Pennsylvania. Thanks to recent prices for crude oil and natural gas at the wellhead, we have a growing and thriving industry in this state. In 2005, just to give you an idea of what the scope of the industry is, Pennsylvania Independents produced 168.5 billion cubic feet of natural gas and 2 million barrels of oil. To put this in perspective, that means that, the natural gas we produced is the energy equivalent of about 30 million barrels of oil that year. To give you a broader scope, Texas produces 7.5 million barrels of oil a day. We produce 2 million barrels of oil a year. Our Commonwealth's natural gas production is about 1% of the total natural gas production of the United States. Still, even though we're a very small industry in the scope of things, in 2005, Pennsylvanians consumed 692 billion cubic feet of gas. We produce enough here to satisfy about 25% of that demand, and that's pretty significant to us. We just got a copy of the legislation yesterday, as you did, and we haven't really had a chance to scrutinize it as closely as we'd like. But there are two things I'd like to point out to you going forward here. First, I agree with John. I believe that the governors and the Revenue Department are trying very hard to write this legislation so that it applies to the major oil companies. If you look at the Section 2202, the section that imposes the tax, and the definition of business entities, you'll see that there's a real effort here to try to do so. However, we think the scope is much wider than that. We also think that there's a drafting error in here that would appear to give the independent producer in Pennsylvania an exemption. We're fairly certain that's unintentional. But again, we're fairly certain that the scope of this bill is not meant to cover as many people as the bill seems to at this point. One of the concerns that we have with this proposal is the applicability its applicability to non-corporate businesses. Section 2202 appears to impose the tax on the profits of business entities that are exempt from the corporate net income tax. Most Pennsylvania independent producers are organized as subchapter S corporations, limited liability companies, which includes private investors, and sole proprietorships, which are family-owned businesses and individuals who produce oil and gas on a part-time basis. Subchapter S corporations and partnerships can elect to have their profits of the company passed on and taxed at the individual level. They generally don't pay the corporate net income tax. Similarly, sole proprietorships and individual producers, as well as private investors, pay taxes on their profits from oil and gas production in the state in the form, as individual taxpayers on their personal income tax. So most of the companies involved in the industry here in Pennsylvania, and most of the individual investors who profit directly from the production of oil and gas in Pennsylvania would not be subject to the corporate net income tax and would not benefit from the CNIT relief component of the governor's proposal. For them, this tax is new and a supplemental assessment, and would not be offset by any comparable reduction in the personal income tax or other state liability they may face. In effect, the proposal amounts to double taxation on a producer's income, because the company would have to pay the gross profits tax, while the individual would have to pay the tax on the net income of the company through his personal tax returns. This is a problem as far as we're concerned with this tax going forward. We've heard a lot about the combined reporting element of the tax. If this bill considers independents that produce crude oil to be an oil company, the combined reporting provision casts a very wide net. Of paramount importance to us is the fact that it would impose the tax not only on a producer's crude oil production, but also on his natural gas production. And in that form, it would have a much more substantial impact on the state's extraction industry than if it were applied solely to crude oil production. There are a variety of other permutations of this concern that I've put forth in my testimony, and I won't go over them here for sake of time. I would like to point out, though, that the way the definitions work, it looks as if we may be creating artificially two separate classes of producers in this state for tax purposes. The oil producer, whose all of his oil-related income and non-related business income would be subject to the gross profits tax, as well as an independent who only produces natural gas, who would be subject to traditional state tax law. If this proposal applies to crude oil production and not to natural gas production, it will have the effect of forcing producers to divest themselves of their crude oil holdings in Pennsylvania and discontinue any new investments in the state's indigenous crude oil reserves. This could have a very significant impact on the city of Bradford in McKean County. This is a city where the Commonwealth has invested millions of dollars in public funds a few years ago to ensure the continuing viability of the only remaining oil refinery in the state that processes Appalachian Basin crude oil. The American Refining Group's refinery uses approximately two-thirds of its supplies. What I'm trying to say here is two-thirds of its oil supplies come from Pennsylvania producers. Without Pennsylvania's crude oil production, ARG would face very serious supply problems and potentially devastating economic harm. This legislation also defines gross profits in a way that ties them to the company's federal tax returns, and it does so in a way that would calculate gross profits on the total sales of the oil company minus the costs of goods sold for federal tax purposes. The IRS excludes a variety of costs related to oil and gas exploration and production from the calculation of the cost of goods sold. In fact, for a producer, there's very little that's defined as the cost of sales for federal tax purposes. Consequently, to us, it appears that this tax, as a gross profits tax, would be imposed on the gross receipts of production that a producer would earn in this state, which means that we would be taxed on the wellhead or wholesale value of all of the oil and gas that we deliver to market. As an aside, I mentioned a moment ago that we may be creating two classes of producer here. The oil producer who would be taxed on everything he does, related or not, to his business, and the gas producer who would be taxed under traditional state tax law. In fact, most producers produce both oil and gas. Most companies in the state are natural gas producers. That's the main business in the state anymore. But most companies do, in fact, produce some crude oil with their production. So they would more or less be, the tail would be wagging the dog here, and they would be, in fact, drug into this tax system, it appears to me. As I mentioned to you, Pennsylvania's independents produced 168 billion cubic feet of gas and 2 million barrels of oil in 2005. The average wellhead price of natural gas paid to producers in 2005 for natural gas was $8.86 a thousand cubic feet. The average price of crude oil paid to the producer at the wellhead was $53.79. You put all these numbers together and you come up with the gross profits in this state earned by Pennsylvania producers from the production of our indigenous crude oil and natural gas of about $1.6 billion. If the governor's new oil company gross profits tax were applied to that sum, it would have generated about $99 million in tax revenue that year. And this sum does not include any additional tax revenues that may have been raised because of the combined reporting rule. Senators, that is $99 million that would be removed from the resource-based economies of hundreds of rural, western, and northern Pennsylvania communities to subsidize mass transit in the state's southern and eastern urban centers and suburban counties. This is capital that is largely reinvested in rural communities where the oil and gas is produced. The money is spent for new well drilling, for salaries, wages, and general operating expenses for companies that are involved in the search for and development of new oil and gas reserves in this state, and as signing bonuses, rental payments, and royalties to property owners who lease their land throughout these northern and western counties for exploration and development. In 2006, producers invested about $920 million of their after-royalty profits directly in the drilling of new wells in the state. That money was spent locally on a wide range of materials and services that were purchased from contractors, drilling companies, well service companies, industrial supply stores, and professional service providers that support the oil and gas extraction industry in this state. In 2006, we drilled about 4,200 new oil and gas wells using the profits from 2005. We estimate that the governor's gross profits tax would force Pennsylvania's oil and gas companies to reduce their drilling programs by about 12%. In 2006, that would have meant about 500 fewer wells. The money that our independent producers earn from their oil and gas production is also spent to support substantial job creation in regions of the state that do not have as diverse and robust an economic base as the communities where the tax revenues would be spent. In early 2005, we conducted a survey of the 6 county regions served by the North Central Workforce Investment Board to assess the job creation potential of our industry in that area. The companies who responded to that survey told us that they anticipate creating about 1,000 or more new jobs in that region alone in the next 5 years. More than half of those jobs would be unskilled entry-level positions with drilling companies and service companies and producers. These are jobs that would be available to high school graduates from the region, jobs that would pay higher wages than would otherwise be available to these young men and women, jobs that would give them an opportunity to stay home, to earn a living wage, and build a career. By curtailing the level of capital investment that independents can make in new well drilling in Pennsylvania, this tax would limit that job creation potential. Senator Earl raised the issue of royalties. And we paid out about $200 million of our gross profits that year in terms of royalties to a couple thousand landowners. We're not sure that this tax wouldn't apply to those royalty owners because we're not sure how the bill would apply the tax to gross profits. Would our gross profits, in fact, include those royalties before we pay them out? We don't know that, and it's one of the questions that's in the bill that needs to be answered. Let me conclude by saying that, when the governor proposed this tax, he suggested that the revenues would help you get beyond the regional conflicts between the urbs and the suburbs created by the demand for state tax dollars for roads and bridges on the one hand and mass transit on the other. This proposal may circumvent such regional conflicts, but it also creates a new battleground, we think. It creates a new rivalry between the state's urban and suburban centers on the one hand and its rural counties on the other hand. You're basically looking to tax the revenue streams that only exist in certain portions of the state to fund the needs of communities in other areas of the state. The assumption behind this tax also seems to be that we'll be collecting a new revenue source from outside the state, tax revenues from multinational oil companies that have no stake in Pennsylvania and would feel no pain from a $760 million tax levy against their billions of dollars of profit. That assumption ignores the implications of this tax if it's imposed on the indigenous oil and gas industry that we have here. This tax will not be painless for Pennsylvania's homegrown oil and gas producers, and it could have some very significant ramifications for the communities where they live, work, and invest their capital. Thank you very much for this opportunity. I'm sure all of us would be happy to answer any questions that you may have.
Thank you. I'll defer my questions and go to my committee. Senator Stout?
Yes, Mr. Chairman. Could the panel tell us how you handled the oil franchise tax that has been applied to fuel in Pennsylvania? It came into effect in the 80s and had its major impact on revenues in the 90s. How that was handled, the oil franchise tax. Yes, John.
Well, I'm going back here a bit, and I started representing the industry about 1981, 1982, so this was going on, but I wasn't directly impacted. What my folks tell me is that the big push of that, the first oil franchise tax passed in the Thornburg administration, was that it would not be passed on to the public. I went back and read the original bill, and there was like one line that kind of referenced that in the law. But within a couple years later, in part because our people started threatening to either sue or raising more than a little concern across the state that they were being forced to eat it, I think within 2 years or 3 years, the whole thing was kind of changed. And ultimately, I think it's still described as the oil franchise tax, which is charged to the business, even today. But I'm just assuming that most of the time it is passed on because there's no prohibition. But the big headline back in those days was, we're going to come up with a tax that isn't passed on to the consumer. And within 2 years or so, that was, the whole tax was kind of rearranged, but it then was. But having said that, in the last couple of years when we finally bumped the threshold on that tax, and the announcement comes out every year from the Revenue Department of what the average wholesale price is, then alerts the tax collectors, who in many cases are our members, January 1st, this is what you charge. And we did have an increase of 1 cent or so, a couple years ago that hardly made a blip in the headlines. But originally it was sold as it's not going to be passed on to the consumer.
In the chain of suppliers, a lot of my district's served by Gutman Oil, and they have river barge tankers, and they go down to the Mississippi River and get product in Louisiana and Texas, and bring it up to southwestern Pennsylvania. So now, on this proposed tax, they would be applicable to that?
Well, I don't want to speak for their individual company circumstances, but Gutman Oil is the type of business that would theoretically be heavily impacted by all the activities that you mentioned, I think would be included for any company in this law so far. In other words, a company, a distributor of which Gutman is, does sell to other entities, does import gasoline in a variety of ways, et cetera, et cetera.
Earlier I asked a question about how, because the increased price of offshore oil, like OPEC-controlled oil, do the prices in these foreign companies, are those taxes? How do they get into the price system at the pump? When you have to pay a tax in getting fuel out of Saudi Arabia or somewhere that comes into this country, I understand the OPEC natures put a certain tax, additional tax on the crude oil Now, how does that structure get into the pump prices for consumers?
Well, as an economist, I generally tend to stay away from complex tax issues because they are very, very challenging when you get at the international level. You do have royalties also that are included in international producers' levies. You have taxes, and then you have the U.S. tax treatment for foreign source income that comes into play. So the combination of all those things makes for a very difficult analytical challenge to see how it would directly influence the price at the pump here. Recognizing, however, that any time you tend to have an increase in the cost of producing oil or petroleum products, that it tends to have an upward pressure on price. But quantifying that is an enormous challenge, Mr. Chairman.
Are the taxes that are applied by a foreign entity, offshore entity, are those taxes then subject to those same taxes in the U.S.?
Sometimes those taxes can be charged against some of your U.S. tax burden, but it's a very controversial issue. The Congress has been debating the international tax issues on trying to basically raise the tax burden on those companies. Beyond that, it varies by the country involved in terms of the revenue system they have, royalty, production incentives, or taxes. So it's very complex in terms of how it actually flows through the system.
Thank you, Mr. Chairman.
Thank you. Well, I guess I have several questions, but to John Kulik, in real dollars terms, can you figure out how much Pennsylvania businesses will pay for this painless tax?
We will calculate something for you, Senator, get it to you. We, having seen the draft yesterday, want our members in their accounts to take a hard look and get us back that number from the
I
draft.
appreciate that, and certainly there's a lot of unanswered questions of how it does impact our distributors, and, we have a major problem, I think, and it was being sold as being on the big oil companies, conglomerates, what have you, and yet it may hit, as the two of you have pointed out, what the impact can very well be just on our Pennsylvania producers and distributors.
If I can, I will stand corrected, and I don't mean to, the Revenue Secretary is not here. I thought I heard him say earlier, but I will stand corrected, that in looking at the refiners, somehow they calculated $360 million, which makes me wonder where they came up with the $730 million, if it isn't from other sources outside that initial cut. So I will provisionally say that that seems to be a number that I'm hearing, and we'll get back to you with more details.
Would appreciate that. In terms of competition level in the oil business, is it robust? As I guess you'd go back, from the, over the last 9 years, there's been a lot of mergers, what have you. How is it? What is our competition level today as far as in your area, and I think overall? I think this is something that would be helpful as we take a look at this.
Mr. Chairman, I think we have a very competitive system across all components of the gasoline industry. Refinery industry concentration has increased, but is still highly competitive. Much is made, I think, is inaccurate analysis that the mergers have led to less competition. There has been one study that we felt was deeply flawed. And if you look at our concentration as an industry compared to many other consumer industries, say car companies, we're much less concentrated. In Pennsylvania, just looking at, and colleagues can address this, I think Pennsylvania has one of the most competitive gasoline markets in the country. Very, very competitive in terms of the the high-volume sellers that you have here. And so sometimes when I cross the state line from Maryland to Pennsylvania, I see prices drop, even though Pennsylvania has higher gas taxes than others. Part of that is due to a conventional gasoline, but also highly competitive conditions.
I'd like to add something here. In terms of the competition is very robust and very healthy, but it also leads to very volatile pricing over the course of time. We looked at the impact on our industry generally to see exactly what kind of tax revenues would be coming in from this tax on the basis of wellhead values of production in the state. And if you look at just the natural gas side of things for a moment, to see the implications here going forward for the revenues flowing into the tax system from our side of it. I mentioned in the testimony that we would produce roughly $90 million of revenue in 2005 from the natural gas side alone, because of the way the tax, if it were levied against the wellhead value of natural gas production. That's because we earned $8.86 a thousand cubic feet in 2005 for the production that year. In 1999, by contrast, when there was in fact more production in Pennsylvania that year, the wellhead value of natural gas at the time was $2.56 a thousand cubic feet. So if the tax would have been in place in 1999, it would have only generated about $27 million in revenues, whereas in 2005 it would have generated 90 from natural gas sales, if it applied to natural gas sales, as we think it does. Then in 2006, while we don't have production numbers yet, we know that production appears to be dropping from 2005 to 2006, but we do know that the price of natural gas at the wellhead dropped by 16% from 2005, to 2006. So right away you're talking about a fairly substantial drop in the amount of revenues that will be flowing into the system as a result of that. Excuse me. The point here I'm trying to make is that the funding stream could be fairly uncertain and fairly volatile going forward. And I don't think that that's any basis for funding mass transit. You're going to need a substantial, you're going to need a secure cash flow to come in to fund mass transit, and you're going to need some assurances that cash flow is going to be growing over time. You don't have those kind of assurances when you're running a tax on the basis of a commodity market like we have in oil and gas.
If I may, I certainly compared to 10 years ago or 15 years ago, I mean, you have ExxonMobil, not Exxon and Mobil. You have BP, not and Amoco, you understand that. I'm not disagreeing with API's reference to competition, but I would suggest that where your constituents really see competition is at the street level. And that's strong, but on narrow margins. And to keep that, as John indicated, he sees a very competitive situation here in Pennsylvania. That's because you still have segments of the industry that are still out there fighting every day to stay in business. And ultimately, have taken 6% out of their profits is going to have a dramatic impact on that level.
Thank you very much. There's no further questions.
Just one question.
Yes,
Roger.
Senator Stout.
If natural gas is subject to this tax, how do we treat that? In many places in southwestern Pennsylvania, they have large storage pools. They'll pump in gas during the summertime when the demand is down and then market it in the winter at the higher price. Would the person distribute that have to pay it on his cheaper price in the summer, or would he have to pay it at a higher price towards the winter?
We don't really know how to answer that directly, but I can tell you that if a company is an oil company under this tax, and he happens to have as an unrelated business an interstate pipeline and a natural gas storage field, the revenues from those entities would be included in this tax. So this is one of the ramifications of this combined reporting rule that we're putting forward here.
I think the public is very confused. You see on television where the price of a barrel of crude goes up $5 or $6, and before morning the gas pumps go up 10 cents. so people don't understand how that gas got from the mid-east to Pennsylvania in a matter of 10 or 12 hours. That's all, Mr. Chairman.
Thank you, Barry. Thank you, all four of you, for your presentation. I think it's been very helpful. I think a lot of questions have been raised by this proposal, certainly in the minds of this committee, and I think most of the General Assembly, and your efforts to help clarify or cloud the issue. You've done a great job. Thank you. The hearing is adjourned.